Let's start with getting an understanding of what the stock market is. The stock market is a place where investors connect and are able to buy and sell investments. These investments are mostly stocks, which are shares of ownership in a publicly traded company. When people talk about the stock market, they often refer to the indexes, such as the S&P 500, Dow Jones Industrial Average, and the Nasdaq Composite. This is because it is much harder to track every single stock. These indexes include a section of the stock market, and their performance is viewed as a representation of the overall. The concept behind how the market works is relatively simple. The stock market works through a network of exchanges like the New York Stock Exchange or the Nasdaq. Companies are able to list shares of their stock on these exchanges through a process called an initial public offering, or IPO. Investors then purchase those shares, which allows the company to raise money and grow its business. Investors can then buy and sell these stocks among themselves. The exchange then tracks the supply and demand of each listed stock, and the supply and demand helps them to determine the price for each security. I know all of this might be confusing, but think of it like this. An exchange is a place where companies are bought and sold, like an auction house, and the investors or stockholders are the people who come in and negotiate the prices and make trades. Now that you have a little understanding of what the stock market is and how it works, let's go over the positives of investing. With any investment, there are risks, but with more risk tends to come more rewards. Stocks are a clear example of this, as you don't have a clear return on your investment. However, the market's history of gains suggests that a diversified stock portfolio will most definitely increase in value over time. Now, I'm sure you're saying, well, how the heck do I come up with my own diversified portfolio? Well, don't worry, because you can invest in a mutual fund that will do it all for you. These funds will passively mirror the performance of an index by holding all the stocks in that particular index. Stocks and mutual funds are very ideal for a long-term horizon and safety, with an average return of 9% over the last 50 years. As you can see here, one of the major indexes is the S&P 500. The S&P was first created in 1926 and initially was invested in a total of 90 companies. Now it holds 500 of the largest publicly traded companies. There is a committee who regulates what stocks are allowed into the index, and there's a certain criteria each stock must meet. If it fails to meet this criteria, then the stock is pushed out. This allows the average investor to know that by investing in an index like this, they are getting all of the best companies that have shown profitability and growth throughout the years. There are indexes that mirror the S&P and invest in the same stocks that it invests in, and these are IVV, VOO, and SPDN. But any of the four are perfect. So one thing that I want to touch on is the fact that timing is everything. So time in the market beats timing the market, as said best by Warren Buffett. And this by itself just means there's no point, if you're investing in the long term, to try to time dips and perfectly get into the stock, because that's physically impossible. The best thing for you is to get into a stock that you believe will be profitable in the long run and just sit on your hands. Do not sell during those short-term pullbacks and watch it ride, because if you try to time those dips and when it rallies, it's impossible, and the only thing that can beat that is time in the market. So I'm not sure if you guys know who Warren Buffett is, but he's had an average rate of returns of 17.1% since 1985, which is crazy. He owns his own investment firm and called Berkshire Hathaway, and if you would have invested $10,000 in Berkshire Hathaway at the start of 1985, you would now have 2.4 million. I understand 9% on your investment, that sounds like nothing. Well, let me put it into perspective for you and show you the power of compound interest. The average age of retirement is 68. Let's say you start investing at 28, which by then you'll most likely be out of college with either a career or a pretty stable job. The average income for a 28-year-old in the United States of America is $40,000 a year. If you're able just to save 10% of your income and invest it per year, by the time you're 68, you would have invested $160,000 of your own money into the market. That's crazy. Well, it gets better because on an average return rate of 9%, that $160,000 will now amount to $1,350,000. And this is from doing absolutely nothing other than investing 10% of your income every year into a mutual fund. Now, maybe you find that boring, and that's why, if you're young and willing to take on a little risk, I would advise putting some money on the side that you're able to invest into different companies that you know and believe in. For example, if you were one of the many students this year who was pushed onto Zoom during 2020, and you said, with all this traffic that Zoom is getting, I bet their stock will go up and they will turn profit. Well, go up it did. And if you would have bought Zoom when everything shut down in March, at its peaks, you would have been up over 300%. This does not have to be your whole portfolio going into these stocks, but saving a little cash on the side so that you're able to buy into these things when you see the opportunity to makes a difference. By doing this, that year that you were able to find that investment that's able to outperform the market, your portfolio may gain 10 to 15% that year instead of 9%, which is a big difference. Now that you know what the stock market is and the positives of investing, let's go through the negatives. There are none. I'm kidding, of course there are. Every penny you invest in the market, you should be prepared to lose. The stock market is in no way free money and does come with plenty of risks. However, if you're able to manage that risk and don't risk more than you're willing to lose, you will have no problem investing. Another problem that people tend to get caught up in are the short-term trends. If you're investing for the long term, do not worry about the short-term trends. I cannot express this. I'll give you an example. In 2019, David Dobrik, a popular YouTuber, bought 3,000 shares of Tesla at $325 a share, totaling $1 million. He did this because he believed the company had a big impact on the youth and was a good investment for the future. The day after he bought, the stock dropped, and he was down $80,000. He then waited for Tesla to go back where he bought it at and sold for break even. If he would have continued to hold today, that investment would be worth over $13 million. He believed it was a good investment and got scared of the short-term trends, so he sold out. If you really believe in a company, short-term trends mean nothing, and in the long run, you will have profitable returns. Lastly, now that you have all this knowledge, you're probably asking yourself, well, how do I get started? There are many ways to get started, but the first thing you'll want to do is figure out how much you can afford to put aside and invest, and what brokerage you will use. Here are 3 of the easiest brokerage to use, in my opinion. Robinhood, Webull, and TD Ameritrade are 3 easy, simple to use platforms that you can begin investing with as little as $1. And with Robinhood, you can even invest in fractional shares, which means you can put $10 into a stock like Amazon instead of having to buy a whole share for $3,000. You will still profit off of the percentage gain that Amazon increases. With my link in the description, you can sign up and get 1 free stock on Robinhood, so make sure to check that out. The only regret you will have about long-term investing is not starting sooner. Make sure to tune into my video next week where I will talk about how I pick the stocks that I like for my long-term portfolio. Thank you all for watching, and if you got to the end of the video, please make sure to hit that like button and let me know what you think down in the comments. See you next